February was a month of two halves for markets. The first half was, like January, dominated by growing noises that the Federal Reserve and other major central banks will be embarking on an aggressive tightening cycle to combat persistently high inflation. The second half, however, was dominated by a massive risk-off move as the warnings of a Russian invasion into Ukraine became reality. This action by Russia has resulted in severe sanctions, the ramifications of which are still unfolding. Unsurprisingly, the biggest market moves have been in Russia itself. Russia's MOEX equity index has shed 30% in local currency terms, making it the worst monthly performance since Russia's financial crisis in August 1998. On a US dollar basis, the return is even worse at negative 48.4%. This is because, as well as Russian equities collapsing, the ruble has also weakened, dropping 26.3% in February. The equity returns are in spite of no stock trading taking place on the last day of the month. Russian index ETFs, however, point to a further decline of 30% that is not factored into the monthly numbers. The risk-off event meant that the S&P 500 dropped 3%, the Euro Stoxx 50 dropped 5.9%, emerging market equity dropped 3%, but the FTSE 100 gained 0.3%. What supported the FTSE's performance was the heavy commodity exposure the index has. Europe was hit harder than other major regions, primarily due to the proximity of the conflict. The conflict's implications go far beyond Russia, however, with numerous commodities surging in February, which will have significant inflationary consequences for the world. Brent crude oil was up 10.7% over the month to more than $100 a barrel for the first time since 2014. European natural gas was up 16.4%, wheat was up 21.9%, and aluminium was up 11.5%. The broad-based commodity index was up 6.2% in February. These commodity price rises will make life difficult for central banks going forward, as they are in the near term inflationary, but also potentially growth sapping. The former is usually combated with higher interest rates, but the latter is usually combated with lower interest rates. Additionally, given any commodity-induced inflation will be supply-side led, it is questionable how effective raising interest rates would be in dealing with the issue. The dual nature of the month made itself apparent in bond markets, as sovereign bonds initially selling off in the first half of the month on fears of rate hikes, before rallying slightly into the tail end on geopolitical fears. The flight to safety aspect of bonds was tempered as the nations involved in the conflict are important commodity exporters. Thus, commodity disruption would be inflationary. The broad-based bond index, the Bloomberg Global Aggregate, was down 1.3% in the month. As the risk-off sentiment permeated markets in the second half of February, the chances of a 0.5% interest rate rise by the Federal Reserve decreased from 100% to 10%. Finally, in FX, there were no major moves, although the broad-based US dollar index, the DXY, was up 0.2% in the month.